As you'll see shortly, the markets did really well. And what caused this uptick across markets? The ADP non-farm employment change came in much lower than anticipated. We saw the GDP preliminary quarter-on-quarter come in slightly stronger. The jobs openings, JOLTS job openings, came in stronger than anticipated as well, and pending home sales month on month actually decreased. But the real issue was Fed Chair Powell in his speech. I break down the actual words that Jerome Powell talked about, and there's a lot of things in here that people are just glossing over. They're literally cherry picking, and they're not looking at the statistics. It's important to realize that this has happened many times before. People tend to cherry pick information, data, and statistics, and then they find they're standing on basically thin air and the markets drop. I'm going to explain exactly what is in Jerome Powell's speech so that you can do your daily three-dimensional risk management. And we're also going to look at some statistics. We're going to see how global markets are progressing and some other things that you really need to be aware of. Stay tuned, this is a really important video. Hi everyone, I'm Ken from CryptoTradingKS and the inventor of the CTKS method and BORSOG trading. If you're new, a very warm welcome and welcome back KS family, and please note I don't have WhatsApp or Telegram. From my 30 plus years in financial markets, I explain the smart money mindset to assist you to be more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process. Let's run the numbers. Bitcoin is currently up 3.93% to 17,090. Ethereum is up 6.18% to 1294. Let's start with Jerome Powell's actual speech, and it's really important to go towards the source of information. You can just literally go across to federalreserve.gov and look at their news events. If you look at the news headlines, it's basically everything is fine. Dow jumps more than 700 points to exit the bear market. Jerome Powell signals that the Fed is prepared to slow rate rise pace in December. In other news, Fed's Powell, rate hikes to slow but adjustment just beginning. And in other news, stock traders cheer Powell's risk-friendly shift. The next FOMC meeting is in about 14 days, and what's the expected increase in the FFR, the federal funds rate? It is currently 50 basis points with a 79.4% probability. From the backdrop of retail news, we would expect Jerome Powell to say some really good things in his speech. As a community, we have a smart money institutional mindset. We don't care about what retail investors and traders are looking at. We care about what is actually being substantiated by facts and data. And we don't cherry pick comments. We put all comments into perspective. What Jerome has said here, the reality is that inflation remains far too high. Just in the opening remarks, he's already said inflation is a problem. And that problem imposes significant hardship, straining budgets and shrinking what paychecks will buy. He goes on to say that there have been decreases in inflation in the past, but down months in the data have often been followed by renewed increases, which means that temporary dips can be temporary. To understand where overall inflation is headed, he's focusing on core PCE inflation, which omits food and energy inflation. And the concept is, inflation has moved stubbornly sideways, and the path ahead for inflation remains highly uncertain. These first few paragraphs are not reflected in those news headlines that I showed you. Jerome says we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. And ongoing increases will be appropriate. And this is a critical point. The ultimate level of rates will need to be somewhat higher than thought. They were thinking the 5 to 5.25% rate. It's suddenly become more than 5.25%. Just keep this in mind. This particular sentence is significant, and don't forget, there are actual speech writers writing this because they know, the Fed knows, that the markets will react quite badly to any negative news in here, so they always throw some positive stuff around. But just be aware that the real meaning is hidden underneath these words. He says, we are tightening the stance of policy in order to slow growth in aggregate demand. And that's likely to require a sustained period of below trend growth. What does this mean? Basically, they're going to be restrictive. They're going to raise the federal funds rate, which will push interest rates up and therefore put a credit squeeze into the economic system. A higher cost of borrowing means people are just going to find less work out there because employers will need to cut back because their expenses will increase. He says the GDP was roughly flat throughout the first 3 quarters, and indicators point to modest growth this quarter. And they can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. That means they're going to crunch GDP. They're also saying, despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. Then he seeks to understand, by the lens of breaking down PCE into core goods inflation, housing services inflation, and inflation in core services other than housing, to try to understand what is the problem. Core goods inflation has moved down, and this is a good thing. But housing services inflation has risen rapidly, and that is the major problem. But there's also another problem, that when we come to consumer inflation, that's being driven by a very tight labor market, and we'll have a look at that in a minute. Supply chains are now easing. Fuel and non-fuel import prices have fallen in recent months. And this is all slowing the inflation in relationship to core goods. And if this trend continues, notice the words if trend continues, goods prices should begin to exert downward pressure on overall inflation in the coming months. And that's good. That's what we want. Housing services inflation, which measures the rise in the price of all rents, and the rise in the rent equivalent cost of owner-occupied housing, has continued to rise, and it now stands at 7.1%. This is a lagging indicator of inflation, but new leases is much, much faster, and new leases rose to nearly 20% inflation during the pandemic, but have been falling sharply since about mid-year. But overall, housing services inflation has continued to rise. And this is likely to continue well into next year. Note the word well. That means substantially into next year. When we look at core services other than housing inflation, and this spending category covers a wide range of services from healthcare and education to haircuts and hospitality. And it's the largest of the 3 categories, which is more than 50% of the PCE index. And therefore, it's critically to understand this future evolution of core inflation, because wages make up the majority of this. And here's where the really big problem is. The demand for workers far exceeds the supply of available workers by the tune of about 3.5 million people. And you can gain some idea when you look at the jobs worker gap. All of these job openings, but the available workers, they're not there. They're not in the economic system. And that actually puts upward price pressure on wages and keeps what's called a tight job market. When COVID hit, a lot of people stopped actually participating in the workforce for a lot of different reasons. And the Fed basically says this is probably about 2 million of that 3.5 million gap. And the other 1.5 million missing workers is likely due to a plunge in net immigration and a surge in deaths during the pandemic. The issue for the Fed is that unemployment is near a 50-year low at 3.7%, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. Said another way, for every person looking for work, there are about 2 jobs that person could be hired for. And this allows a lot of employees to cherry pick their employers. That is, they can pick the best job that they want. Compounding this with slower GDP growth, and this is where the GDP stats come in. What actually happens is that businesses have restricted hiring from about 450,000 per month down to 290,000 per month. And when we look at the ADP, non-farm employment change, they expected 196,000. They got 127,000. This further puts price inflation under the hammer. And something to note, job openings exceed available workers by about 4 million, but job openings have actually fallen by about 1.5 million this year. This creates a real problem for the Fed. The Fed is all about demand destruction. Hey, just manage the economy by destroying part of it. Why do they need to do this? Because they're playing out of a very ancient handbook, an economic handbook on monetary policy. You can see, despite all of those news headlines, which just reflect current market conditions, the underpinning condition of the economic system is one of contraction. So what does the Fed want to do? It needs to bring inflation down to its target rate of 2%. How does it do this? Growth in economic activity must slow well below the longer run trend. This means that the natural rate that the economic system would grow, they need to suppress that and they need to keep it there. They want to bring supply back into balance with demand. When goods production increases, when it eases, it actually takes inflationary pressure off the table. For example, if you want something and you can't get it, people are likely to pay more. But when there's plenty around, hey, it's all everywhere. You don't need to worry about paying more. You can just go to the competitor next door. One of the major problems is housing service inflation, and that will probably keep rising well into next year. Well into next year. That means at least 50% of the year. That means we can expect at least 6 months into 2023 where housing service inflation will be problematic. If inflation on new leases starts to fall or continues to fall, that is of course really good. But the labour market is the problematic one because of those structural reasons. That's why wage growth remains well above levels that would be consistent with 2% inflation over time. And therefore the key line, we have a long way to go in restoring price stability. When you look around the news headlines, they're all so positive. And why is that? Because the market is green. And the stock market is really green. A key sentence is this. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive. This means demand destruction of the highest order to move inflation down to 2% over time. The real issue that they face is monetary policy has lags, and those lags are problematic. Jerome says that the full effects of our rapid tightening so far are yet to be felt. Because of that rapid tightening, and this is where all the cherry-picking headlines are coming in, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. They're just misinterpreting this line. And note what comes next. The time for moderating the pace of rate increases may come, not will come, may come, as soon as the December meeting. But according to news headlines, it will come. It's not a maybe, it's a certainty. But is it a certainty? Jerome says, may come. And what follows next is even more important, and I believe 99.9% of people will not report on this. Given our progress in tightening policy, The timing of that moderation or those decreases is far less significant than the questions of how much further we will need to raise rates to control inflation, and the length of time it will be necessary to hold policy at a restrictive level. So what does this actually mean? Let's break this down. The timing of that moderation, he's talking about decreases potentially in December. He's saying the timing is not relevant. It's far less significant. In Fed speak, this means irrelevant, not relevant, than the questions of how much further we will need to raise rates to control inflation. This means Jerome will probably need to raise rates above the 5.5% level, maybe 6, maybe 7%. These are the things that you will not see reported on, because for some reason people do not read the source documents. They just cherry pick information that suits their story. The other thing is this: the length of time it will be necessary to hold policy at a restrictive level. That is all about the easing of rates. When rates come down, they're basically saying, oh, okay, we're just a little bit uncertain as to when we're going to start to lower rates, and it could be quite a way away. And that is increasing because of these uncertain lags in monetary policy. So how does Jerome conclude this analysis? It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. Please let me know in the comments, what do you think all of this means to the markets when actually people start to read the information and they don't read cherry-picked headlines? Some of the figures that came with Jerome's speech are these. Figure 1, total and core PCE inflation. Blue is total, core is in red. And we can see both are starting to roll over. But he says, we're not going to reduce rates just because of a couple of months' data, because what actually happens is it can go down and then come back up. That's what he said previously. In figure 2, we can see that core goods is decreasing, core goods inflation, because supply chains are opening up again. But look at housing services, this light blue line, it's going parabolic. And you can see core services, less housing, that's also was decreasing. Now it's done an uptick. Again, these lags are uncertain within the economic system. Looking at market rents and PCE housing services inflation, keep your eye on the red line. PCE housing services, you can see PCE housing services inflation on aggregate has been coming up. And when we look at the projected labour force compared to the actual labour force, there's quite a gap. And the labour force participation rate just basically fell off a cliff during C19 and has been coming back, but been coming back really slowly, and it's actually starting to stall at the moment. A lot of macro global economic monetary policy is based around the Phillips curve. It's not just the Phillips curve, but it is definitely part of it. When governments say, oh, okay, to bring wage inflation down, all we need to do is to push unemployment up. And how do we do that? We have these things called interest rates. We'll make it so expensive for people to acquire money that they just have to lay off people. And in the 1950s, A.W. Phillips plotted a decade's worth of data on wage inflation and unemployment, and he noticed this inverse relationship. And that's been enshrined in government policy making ever since. The problem is that this doesn't always work, and we can get a thing called stagflation. Stagflation occurs when there's higher inflation, lower GDP because of demand destruction, higher unemployment because of demand destruction, poor government policies, because of demand destruction, and stupid government, which basically just looks at the problem and says, oh, we've only got one hammer, let's use that under all circumstances. What is the Fed actually trying to do? Is trying to bring into balance supply and demand. Why don't you work on the supply side and increase supply? Yes, that will take time, but so is destroying your economy taking time. And we can see that. Jerome Powell said it. Let's just have a quick bolt around the world. And when we look at the ACWI, the All Country World Index, and this covers 23 developed markets and 24 emerging markets, we can see that we're in an uptrend, but there is a weakening of that trend at the current time. But pretty much what's happened overnight in the US markets may cause this to go up. And that's, of course, what we want. But we have to be prepared for what comes next after the full effects of demand destruction are felt globally. And Masterclass students, please have a look at Living Video 13, LV13, Recession Prediction, How Close Are We to One? I go through and explain the 10-year minus the 3-month, Arturo Estrella and his contribution to economic theory. The concept is we've seen this curve fall through the floor just recently. This is superior to the 10-year minus the 2. And if we look at the high yield index option adjusted spread, what we can see is an inverse relationship between Bitcoin and the Nasdaq. And when this spread absolutely increases, it's typically as a result of markets imploding. Just keep this in mind. Now, what are we actually seeing here? Are we witnessing another forming base to explode upwards or decay downwards? Please let me know your thoughts. And this chart is all about credit market risk or credit risk. Let's have a look at the main markets over the past 24 hours. We can see just a huge push up in the major indices, and we can see this literally across all sectors of the US. They did really well. Fantastic. And what happens when this happens? Of course, fear falls. We have had no spike whatsoever in the VIX of late, and this is actually concerning. We're getting very overextended to the negative side. The VIX is always moving in a wave, but it's been going down in a straight line pretty much for quite a period of time. When the VIX finally does decide to spike, we had a little spike about 3 days ago, but when it finally does decide to spike, please pay attention to that. As traders, we're just aware of the macroeconomic landscape. It doesn't actually shake us out of our positions. We just need to know and be mindful of what's going on. We can see that bond prices started to normalize up. Bond yields came down as the dollar sunk, and that put upward pressure on gold. The gold bugs would be very happy at the moment. And look at oil. It just spiked up. And there's a lot of risk-on activity coming through junk bonds as well. And looking into the mechanics of the dollar, we can see the dollar was rejected by a smart money sell level at 106.998. It's currently 105.873. But the one thing that you should be really aware of, it's above a level of resistance. We have had a short-term trend change, so we need to be aware that the dollar, the DXY, may start to strengthen again, and this will catch a lot of people on not only the wrong side of the trade but the wrong side of the percentage. When I was lecturing first and second year statistics, I found that a lot of students didn't understand directional correlation. Directional correlation is not perfect correlation. Perfect correlation, when something goes up, the other thing comes up exactly the same. After all, it's perfect, like a perfect gas in chemistry. It doesn't exist. Concept, directional correlation. When one thing comes up, the other thing can come up, and sometimes it gets a lag, but they move at different percentages. That's directional correlation. And when we look at, for example, Bitcoin's price action against the S&P 500 futures, we can see that the good news from the Fed, but we know it wasn't really good news at all, was it? The markets just rallied. And where did they rally to? The mathematically magical Stanfield level at 40.9250. They hit it and bounced back. This is why these SLs are so valuable. When you actually see one getting violated, no matter what happens in the markets, it doesn't matter. You'll find price tends to oscillate between SLs. They can be an incredible DCA or dollar cost averaging strategy, or they can be incredible for traders for booking in profit and buying and selling effectively in market. We know, Rule 45, your beloved altcoins cannot escape Bitcoin's gravity, and Bitcoin cannot escape the stock market's gravity either. That's why we need to cast a wide net. And we do so because we're smart money professionals. We're looking at investor attention, which is measured by price, and we always track the charts that others don't connect in with the charts they're viewing. We've seen many times that the markets actually react positively to Jay Powell doing his thing. They tend to rally up, but careful, they can reverse down as well. And when we look at total crypto market cap, we can see it literally blasted through two of these SLs, one at 799 billion and one at 808 billion. And I was mentioning yesterday, we would probably need that kind of magical force to just blast through those levels, because then they become weaker. We're cracking the concrete because we've tried so many times to get above them, and there would be a lot of shorts sitting there, potentially waiting to just get liquidated. That's the problem with either longs or shorts. You're always going to get liquidated at some stage. And we can see total crypto market cap is currently $821.3 billion. We have another smart money sell level at $840.58 billion. And we're getting up into steep resistance territory where the smart money will step in and actually sell into the retail hands at $866 billion. Please keep this level in mind. I thought it could be good to paint a few scenarios on what could actually occur. And as traders and professional investors, we're always prepared for any which way price goes, because we know that it can go anywhere. But these structures do offer a lot of support to us to understand, to get the X-ray vision inside the market. If we get a massive move up, just a bit of a consolidation, a minor consolidation around the 840 level could be on the cards, making its way up to that 866. But that is extremely high levels of sell behavior. So don't expect it to go too much further than that at the current time. It could move sideways along here as the sellers push down price, and see if price is going to strengthen or weaken during that case. We could see a bit of a pullback down to this 808 level with a rally up, as many retail investors and traders read the headlines about Jay Powell saying everything is fine and the Fed is going to start quantitative easing, which it's not. It's not going to do that at all, but a lot of people think that it will. Or we could see a continued down play into breaking this 808 level, consolidating around the 799, retesting the 808 and falling through the 799 if there's not sufficient buying pressure coming in to save the market. When we see big moves up like this, of course they need to digest. So potentially this particular part would be the most likely or probable at this time. But we must keep our eye on what actually happens with price. Don't tell yourself a specific story. Just react to the price as it shows you its own reality. Bitcoin is currently trading at 17,218. We've seen it just get past an SL at 17,093. Go Bitcoin! And we know that the stock market is pushing risk on appetite into the crypto space. And Bitcoin was actually preempting that the stock market could be turning around. That was also pretty cool, because keep your eye on Bitcoin if you're in the stock market. There's no riskier asset class on the planet, but that risk actually creates enormous trading gains. I thought it could be useful to throw out a couple of just conservative theories on where price could go from here, looking towards the upside, towards the neutral side and the downside. And what do we actually do first? We always look at the downside because you want to always minimize your losses. You don't want to get caught into a story where things are going to go up and up and up if they're in fact going down. So that's why we do our daily three-dimensional risk management. So if we look at these three, and I've said conservative because Bitcoin can take off like this in either direction. If we just take a conservative approach, we're just at literally the 17093 SL right now. And that's a potential support line because Bitcoin is 17212. We also have support below at 16649. And we've got resistance above at 17988. We can see that we're coming into a lot of resistance around the 18687 and forward, and around the 20,500 mark. There's a lot of resistance. There's a wall of smart money sellers just waiting to dump on retail. Now, please be aware, these are conservative scenarios. If we get something like a cascading sell-off or a cascading rally, that's not included in this. I like to be more conservative. I always like to start with a conservative approach and then adjust your position. If you see price just coming up and up and up like this, just be aware that can happen. If you see price coming down and down and down, like what we saw here, that can happen. But it's not the conservative scenario. Don't forget that these SLs are not formed by recent price action. Recent price action is a very, very big problem in technical analysis. These SLs are formed from all of price action. That's why they actually show market structure. Let's have a quick look at the longs and the shorts. And Masterclass students, you get this live chart in TG34. When we look at the longs and the shorts, of course, we can see the shorts have been liquidated and how. But one thing is interesting. The longs aren't really buying the dip at the moment. Buying this rally at the moment. They're not dipping around. They're not finding support. This shows a lack of confidence on the side of the longs. And the shorts have been lacking confidence for a little while, and they're now currently getting hammered. Let's check out the liquidations. We can see 86.27 million in total liquidations across 25,007 levels of traders. And when we look for the past 24 hours, we can see about 77% of total liquidations were short. Past 12 hours, about 58% short. Past 4 hours, about 83% short. And the past hour, whoa, 90% short. Poor old shorts have been having a bad day. But what we actually see, the volume is not really that great. We're not up into the multi-billion or hundreds of millions of dollars. And remember, there were a lot of shorts getting liquidated up here, which exposed the longs to get liquidated. They've magically disappeared. You control the trade or investment, but the market controls the return, and it will reward you based on your active learning, your knowledge, and your courage. That's why it's so important to do your daily three-dimensional risk management code, and I explained this fully in episode 685. It's literally all about how synchronized in with the market people are. And the institutions are always trying to desynchronize people, always trying to trap people in fear, either fear of missing out or fear, uncertainty, and doubt. And there's a lot of FOMO in the market right now. The greatest gainers in the top 100, GMX, Phantom, Matic, Quant, ZEC, Uni, and LRC. The greatest losers over the past 24 hours, Helium deflating, stablecoin, Dash, XCN, XCN has not been doing well, HT, oh, another stablecoin, and another stablecoin. We know that no alt can escape Bitcoin's gravity, and Ethereum has been following Bitcoin's gravity to an absolute T. As Bitcoin moved up and moved up strongly, what did Ethereum do? It moved up strongly as well. And when we actually just look at all of these things, how about I put the crosshair on and just point to where Bitcoin just shot up? You can see all of the top 8 They shot up at the exact same time. This is why we keep a very close eye on Bitcoin, and it's also the reason why we keep a close eye on the markets. A lot of people don't do this, and a lot of people don't understand this directional correlation, and I guess it just takes time. But when you see it, you can't unsee it. Having a look at BNB, you can see sometimes what actually happens is you get an over-exaggeration or an under-exaggeration. BNB is a little bit weaker than Bitcoin's gravity at the current time. XRP just moving in synchronization. Doge moving in synchronization, but starting to get a little bit weaker. We can see some of these alts starting to show a bit of weakness, but after so much strength, well, that's not a problem. And look at Matic. Matic has just gone absolutely bananas, which is a very important technical term. DOT is doing really well, just moving in synchronization. And Litecoin, not quite as light at the moment. We've seen some really good action out of Litecoin, but it's not doing it right now. Solana has decided to stage a little bit of the comeback and to put itself in the top 16. Well done. And SHIB has also done quite well. You might remember that Tron was over here yesterday. And let's have a look at Tron. Tron just moving in alignment with Bitcoin's gravity. Uni doing very, very nicely, showing a lot of strength. AVAX showing strength. But beware, when you get these big pushes up, what tends to happen? Oh, they retrace. What about this big push? Oh, it retraced. What about this big push? You will see in time, but probabilistically, of course, every push up requires a push down. Why? Because price is always moving in a wave. When you understand this, you're not so likely to FOMO in because there's really no fear of missing out. And we buy in levels and layers down because there's no such excitement as a delayed fill. We can see Atom moving in alignment with Bitcoin's gravity, just a little bit weaker, and Stellar also doing the same. There were so many brilliant comments in yesterday's video. I'd just like to thank everybody. I appreciate you all so very, very much. I thought it was really important to actually go through and analyze the Fed speech for you, just to give you an unbiased approach. Because there was so much analysis to get through, I'll read out the comments in tomorrow's video. In yesterday's comments, we talked about the CTKS method and how it's helped you. Please keep your comments coming and I'll read them out tomorrow. Crypto can be really unpredictable, and that's why you need to keep your mind very, very positive, and we do so through the CTKS Creed. And one thing you might notice is all the stable coins are green. They technically should be red. Money should be flowing out of the stable coins into cryptos, but we can see the money is actually flowing into stable coins. That can mean quite a few things. Please let me know in the comments what you think. One beautiful thing is thought change creates life change. Positive thinking will create a more positive life. Your hard work, dedication and commitment will always be rewarded. The harder you work, literally, the more you will succeed. That's why you can say, I know the universe wants me to succeed, because you're going to put the hard work in to make yourself successful. Because you know you can succeed and you will succeed in life, we have the second line of the CTKS Creed. Every day I show kindness, integrity and gratitude. If you get a setback during a day, you know that opportunities and life reset daily, so tomorrow will be better. Just as a tree takes time to grow from a little seed, you will take time to succeed as well. That's why when you're on your path, always say, I am worthy, I go slow to go fast. Everybody is in a huge hurry to be successful, but that's not the way success is generated. Starting small and scaling is the way. We're all going to get life pullbacks. In life, it's just a way of life. And that's why we have this line in the CTKS Creed. Life pullbacks give me the strength for the next life rally. We never let a problem beat us. We resourcefully find a solution to every issue we face because we are dedicated and committed. And we either win or learn and never blame. And a very big thank you to all the moderators for removing scammers. You're just awesome people. Stay safe out there, my friends. Take care and see you next time. Bye for now.